the chart. Look where the neckline is, basically 164, 165. It's also the 50 MA. So I have those put short, and then I'm long the 160s, which is pretty close to the 100 MA in the backside of the old downtrend line. Then I bought the 170, which is basically this breakout, and then I sold the 180, which isn't quite the all-time high of 185, but if this does run up through 180 to 185, I'll still be getting some delta on that call spread because they'll move closer to 1, right? As it approaches, it'll still expand as it gets to 185, and I'll be banking on the put spread. So what's my built-in hedge? Anyone notice it? This is a 10-point spread in the call spread that I did. And if I'm wrong and this starts to tank, I'll make some adjustments. So what will I do? I'll adjust the upper strike call from being short the 180 to the 175 immediately, which is, look, right into a reference level and not so far away from the channel high. So like, let's say we get the dump first past the 20 MA and we retest the 50 MA down around 164. I'll roll down the 180 to 175. And that'll give me a little cushion and take off some of the pressure. I mean, my max risk here is, the downside here. So that's sort of what I'm watching. I actually would be interested in adding to the trade if it got down right or right out, of course, against the 50 MA, and I'd give it maybe like a point or so. So if this also breaks out to breaks above the 170 and sustains, like let's say there's a gap and go or something like we had here into the next, $5, I might add to it that way too. I did this small. I did it across like a couple of accounts. It was really not a big trade for me, but I would be interested in adding to it. We've been bullish on gold for a while, and I wanted to capture a little bit of that play. We have that trade on right now with GLD. I discussed in the weekend video. It's really a risk reversal, and why don't we just discuss it now? It's sort of it's broken wing at the moment, but gold is starting to pick up. So glad this happened. It always is nice when trades work right away, but we are getting close to some of my reference levels, 174.07, and then the all-time high here is 185.85. I think that's where we're eventually going. It's just to me a matter of time, sort of a matter of when, not if, and that can get a little tricky sometimes. We definitely have had situations where things take a little bit longer to go than we had anticipated. So the GLD play I have on, it's still on, is I'm short a bull put spread and long a bull call spread. So I'm short the December 165 puts and I'm long the 160s. So my risk is capped off there. That area is obviously a key reference area because it's just around this breakout here, right? 159s, 160s, the 100 MA is kind of close to there. We also know 164, just about half-ish. So my short put is 165. It's basically the 50 MA and the breakout. And then my cap off area is here at the 158. So it's really 165, 160 is what I have on. And then I'm long the January, so it's also a calendar. I'm long the 170 calls, which are now nicely in the money. And I'm short the 180 puts. I'm sorry, 180 puts. What am I talking about? 180 calls, which are just above channel high. And if this were to blow through 180, I'd still have enough delta on the calls that I'd still be making money likely up to 85 or so.